Hi, Billy.
Alex?
Good to see you here again. Let's discuss the next week movements in the market, what we're expecting, and what advices we can give to our broker partners for the upcoming week.
Very good.
What do you see on the market? I expect there are some economic data that is to be released, which can imply some volatility in the future, and I think we need to talk a little bit about that in order to give a heads up to our brokers, which both applies to conventional and FHA non-QM rates.
Agreed. The market's been stuck in a trading range. High end of the range was pretty much established on CPI, which was several weeks ago. There's been a lot of bearish news since then. Retail sales have been bearish. PPI has been bearish. And yet the high yields posted back when CPI came out, it pretty much held. And the low end of the range, in the 190s for the 10-year, it doesn't seem...
And what was the CPI? CPI was, just to clarify for our audience, the CPI was what, about 7%, right?
Yeah,
it's 7 and something, 7
and most important in terms of making a market move is it exceeded expectations, as did PPI, as did retail sales. So when they exceed expectations, generally that's going to hurt the market. But it seems like the damage has been done because rates don't seem to want to go much higher.
Right. So basically everyone is expecting inflation to be always, let's say, at 7%, and it comes out at 7.4%, markets goes crazy, right? And I remember for the past, I'd say maybe 3 months, every time I speak to my colleagues, I think every month the number is 1% higher, right?
Right, keeps upticking. Yeah, it keeps upticking, and of late, it's upticked more than expectations. Mm-hmm. And the Fed sees that, which is why we now know they're going to be raising rates going forward. Actually saw an article yesterday, JP Morgan, suggesting rate hikes at every one of the next 9 Fed meetings. So that's their opinion.
Nine increases. That's crazy. Is it a quarter? Is it a quarter increase or some increases they expect to be?
They weren't specific. They weren't specific, and they probably left the door open. So
I remember, I think it was a month ago, Jamie Dimon was one of the first people to project about 7 hikes, and last 2 weeks ago, Goldman Sachs has supported that idea, right?
Right.
And now JP Morgan is at 9.
And I've seen a couple of the Wall Street firms suggest that there will be some half point rises a couple of times. So, and what that tells me is that the market is braced for the worst. So actually, that sort of feeds into the concept that rates, that yields on treasuries kind of got to their highs after CPI, and even with bad news since then, they've not gone much higher. The market's getting deluged with bad news, bad market news. And I think we can read into that maybe we've seen the worst of this cycle up in yields, and things are maybe going to stabilize a little bit. Trading range kind of behavior. That would be my guess.
And what would we see next week? There is unemployment numbers.
Unemployment will be the big one. We get ADP unemployment numbers on Wednesday morning, which usually people don't pay a lot of attention to, but then we get the BLS report on Friday. That's the big one. We get Beige Book on Wednesday afternoon. That gives us a little bit more insight into economic activity. But I think everyone's pretty much got their mind set on economic activity and inflation, and they're all anticipating rate hikes by the Fed, which are going to send the short end of the market to higher yields, and it remains to be seen what the yield curve does and what the long end does.
So until next Friday, it would be a good idea for our broker partners to secure the rates and bring their borrowers on board in order to secure that rate.
I think that's right, and as much as I might believe that somewhere coming close we're going to have a rally, the truth is that surprises in markets typically happen in the direction of the trend. The trend's been to higher yields. Rolling the dice on a number like unemployment's probably not a great idea. I would be locking in loans in front of it. It's just not worth the gamble. So.
You know what is the interesting observation our research department has noticed in the past months? The number of non-QM application has risen drastically due to FHFA movements on second homes and high balance hits. So we see a high increase of applications due to some outflow from conventional to non-QM, and also due to the fact that people who were not able to secure their mortgages, their properties, are trying to get into the kind of on the last stop into a bus. And that's kind of a little bit funny because rates are rising and applications are rising. A little bit of a paradox for us. And we see in the past 2 weeks, a lot of non-QM lenders are catching up with their rates. There were some who are acting pretty fast on the market, and they monitor treasuries, monitor swaps, and go with the market and increase the rates slowly. And there are some lenders who were a little bit late on their increase. They had very low rates for the past months when everyone had already an uptick in their rates. So those guys have either increased their rates by 1%, 1.5% in a single move, and some like unpleasant scenarios where lenders had to cancel on their locks. We even heard such scenarios.
Right. I think again, everyone is of the opinion rates are going up. They get scared. They get spooked with an uptick in the market. Especially, well, let's put it this way: there are lenders out there that are a little bit more sensitive to news. They want to be ahead of the market. They generally end up behind the market more often than not. And so it's a tough call in here. Again, you can't argue that the trend to interest rates is towards higher ones. You also can't argue that the market's gone through an awful lot right now and it's trying to level off. So I think probably Friday's unemployment number, it will probably set the tone of the market for a couple weeks to come, be my guess. And again, if the market does break from here, if the 10-year can get above 208, 209, 210, I could see yields going higher. I think there's some support right in that area, and the decider could well be unemployment.
No, I absolutely agree. I think people should try to secure as many loans at the lower rates as possible before we are entering an environment of higher rates. And we're waiting to March 16. Fed's decision, very important in the coming 2 weeks, and trying to stay on top of the market.
Once again, expectations for the Fed range from 5 or 6 rate hikes to the most dovish projections to as many as 9. The upcoming 6-8 months, maybe even a year, expectations will be a rate hike at virtually every meeting. And then it'll become dicier. But the markets stay ahead of the news. And an awful lot of that is built into where we are right now. A lot of it's built into it, and maybe not all of it. Then economic data starts to matter. Inflation numbers, job numbers, GDP numbers, it all starts to matter.
Absolutely. So let's keep track of that, and we'll meet here next week to discuss what has changed and what to expect for the next Fed meeting.
You got it. Sounds
All
like
right.
a winner to me.
Thank you.